The Reserve Bank has made it clear if wages keep rising without productivity, then interest rates will increase again. Warnings that house prices could fall next year, and new research shows younger and lower income people feel increasingly pessimistic about the future. Welcome to Fear and Greed Business News, Australia's best business podcast. It is Wednesday, the 22nd of November 2023. I'm Michael Thompson, and good morning, Sean Aylmer.
Morning, Michael. That's a fairly pessimistic start to the show, isn't it? I've just realised all those stories are pretty downbeat.
Yeah, you haven't given us any good news there, Sean. Have you got anything positive coming up?
Plenty positive. I mean, it's in the eye of the beholder, admittedly. Some may disagree, but, bad news is good news. Isn't that what we say in journalism?
Yeah, I suppose it's not a good sign when I've asked you if you've got any good news and you've given a qualified yes. So
I know.
Okay.
One of those days, I'm afraid.
Let's see how we go. We've got an interview coming up after the show. This is a really interesting chat. Sam Weaver, General Manager of the Australian operations of Coalition, which is a cyber insurance company.
So this is good news, the fact that you can get cyber insurance. So Coalition is a US-based organisation. It now operates in a bunch of countries, has opened in Australia recently. They use data to assess risk of companies. And we're not just talking about big companies, we're talking about small companies as well. So they use that way they can price ransomware attacks or phishing attacks, that type of thing. You can choose what coverage you want. It's a very interesting model and a very pertinent model, just given how much hacking is going on at the moment.
Yeah, it's well worth a listen. It's coming up later on. The main story this morning, Sean, just when we thought interest rates wouldn't rise anymore, Reserve Bank Governor Michelle Bullock has warned that 4% wage rises cannot be sustained without an increase in productivity, and wages pose a challenge to the central bank as it tries to get inflation back to its 2 to 3% target.
Ms. Bullock said the big jump in wages last quarter, thanks to a big jump in pay for aged care employees and low-paid workers, needs to be matched with an increase in productivity to keep inflation in check. She says we haven't had any productivity growth in Australia for a number of years. In fact, labour productivity over the past 12 months is down 3.6%. That means unit labour costs, the difference between wages and productivity, is increasing at an unhealthy 7.5%. So, Michael, let me just put this for you. If the cost of a unit of labour is up 7.5%, so maybe you were paying $100 a shift, now you've got to pay $107.50 a shift, that has to push through to higher prices at the local cafe or maybe on the factory floor or in healthcare particularly, and certainly in aged care. It's a real problem when that input price is going up, but you're not getting any increase in output.
Okay, I love the fact that you simplified that just for me.
Didn't make sense though.
Yeah.
Oh, good.
Of course it did. Don't test me on it. I believe I understood it. The governor's comments came ahead of the Reserve Bank board minutes from its meeting 2 weeks ago. This is the one where it lifted rates for the 13th time in 18 months. I know you love poring over the minutes. Sean, what did they say?
Nothing like a good minute. In short, they say that if inflation is persistent, then guess what? We're going to have another rate rise. It all depends on how data prints from here. And last week's wages data adds to the argument that maybe we do need a rate rise. The outlook statement in the minutes certainly suggests there might be another rate hike in the offing. They put out forecasts and they predicated on, yesterday they came out and said they predicated on 1 or 2 more rate rises. Now, one of those would have been the one from last week. So it is predicated on potential of another rate hike. So they're obviously thinking about it. The view among economists out there is that there will be one more rate hike, probably not next month after the December board meeting. They don't meet again until February. So that's the most likely date, according to economists at the moment anyway.
I reckon that might be my all-time favourite quote from you, Sean.
Ooh. What did I say?
Nothing like a good minute.
Oh, our good friend Adam Lang would love a good minute.
Goodness me. Let's move on very quickly. Local markets, how did they perform yesterday?
The S&P ASX 200 closed up 0.2% to 7,078 points. The materials companies did best on news of a Chinese stimulus package for the property sector. I'll tell you about that in a moment. BHP jumped 1.4%. Rio Tinto was 2% higher. Energy and financial stocks also did well, while utilities were among the worst performers. Real estate investment trusts were also lower. The Big Four banks and Macquarie Group were a bit higher, but the retailers had a bad day. Woolies and Wesfarmers both closed lower. Industrial property giant Goodman Group and tech leaders WiseTech Global and REA also closed down. In corporate news, Technology One's share price fell despite the group reporting a 16% jump in net profit on the back of higher revenue. Star Entertainment edged higher after the casino operator formally signed an agreement on its revised tax rates with the New South Wales government. Brickworks fell nearly 3%, even though it upped its full-year dividend. And the Origin Energy vote draws closer. It's on tomorrow. Though proxy votes, and many of the big shareholders would have done it via proxy, they were tabled yesterday. They had to be in by 2 p.m. yesterday. Now, the group's 17.5% shareholder, Aussie Super, opposes any deal. We know that. It's voting against the deal. They need 75% of shareholders to vote for it. If any proxy votes came in and voted no yesterday, just park Aussie Super, but let's say some other big shareholder did that, the board actually has the opportunity to go back to that shareholder and argue the case to vote yes. So the vote really isn't final until the shareholder meeting is held. Yesterday, Origin's share price closed down 2% to $8.28. Given the offer price is around $9.43, it certainly suggests that shareholders don't think this deal will get done.
All right, we shall find out tomorrow. What's happening in international markets?
Well, the big news was that Beijing has drafted a list of 50 real estate companies that will be eligible for financing as the government moves to prop up the economy. You think property is important in Australia? Much more important in China. The so-called whitelist immediately boosted sentiment in the real estate sector and beyond. Commodities, for example, iron ore prices jumped. That commodity is a major ingredient in steel. So if the real estate sector is doing well in China, iron ore prices are likely to rise, good for BHP, Rio Tinto and Fortescue Metals. Otherwise, oil held the bulk of its 2 days of gains on speculation that OPEC Plus may deepen supply cuts at its meeting this weekend. And the Australian dollar climbed to a 3-month high yesterday, over 65.5 US cents. It's benefiting from a weaker US dollar and a rising Chinese yuan.
Okay, well, got a little bit of kind of moderately good news there, haven't we?
Yeah, I think so. Look, in terms of bad news, mostly bad news, but, a higher Aussie dollar, that was kind of good. Better iron ore prices, that was good. Some share prices went up, good. If you're an Aussie Super supporter, good. The Origin Energy vote doesn't look so good. Not so much if you're not.
It makes an interesting point, isn't it? In business news, it's almost impossible to have kind of objectively good news because good news for someone is going to be bad news for someone else. You've got the Aussie dollar rising. It's going to be good for some, not so good for others.
Yeah. Think about interest rates. We talk about interest rates going up being bad. Not if you're a pensioner and you're relying on term deposits. It's great news.
Goodness, I think you can actually hear my epiphany. I've just had one.
How long have we been doing this show, Michael?
Probably too long. It's a very delayed epiphany.
Yeah, too long for you to only have realised that now.
Okay, well, we'll be back in a moment with the rest of the day's business news. Sean, geopolitical tensions are among the biggest challenges facing Australia over the next few years, according to a chorus, really, of senior business leaders speaking at the ASIC summit yesterday.
I'm worried about this story being hijacked by the collective noun chorus of senior business leaders. Done already?
It's been done. It has been. It's a very serious story, but all I can focus on now is the idea, just this image, this mental image of these business leaders all singing up, standing up there. And
you had the Future Fund boss, Raphael Arndt. You had Reserve Bank Governor Michelle Bullock. You had Jim Chalmers, the Treasurer, all standing there together, singing.
A glorious baritone, Jim Chalmers. I've got no idea.
Okay, that's right, mate. The Future Fund's Arndt said the possible re-election of Donald Trump late next year marks quite a dangerous point in history. Jim Chalmers and Reserve Bank Governor Michelle Bullock all warned that geopolitical tensions are among the economy's biggest challenges. Chalmers told the Australian Securities and Investments Commission conference that the next 2 years of growth will be the weakest in the past 2 decades, outside, of course, the global financial crisis and the COVID pandemic. Art noted that growing inequality between different generations and the public process underway at the moment by the Trump campaign to identify and potentially replace senior US public servants, he doesn't like it. He said, while it's legitimate for a newly elected government to do it, if it happens, it will certainly change the direction of the world's biggest economy.
Yeah, and speaking of geopolitical tensions, Sean, Beijing has warned Australia against making reckless and irresponsible accusations against China after Prime Minister Anthony Albanese criticised China over an incident last week in which Australian Navy divers were injured.
China's Defence Ministry said Australia's recounting of the incident in the East China Sea last week was inconsistent with the facts, and Beijing had launched a complaint to Canberra. The incident, which occurred last Tuesday off international waters near Japan, was called an act of aggression in a US Senate committee over the past 36 hours or so. Yesterday, a Chinese foreign ministry spokesperson said its nation's military was highly disciplined and always acts in accordance with international law and practice. She said it's important to protect the momentum of China-Australia relations. Of course, they're back on track after the meeting earlier this month between Anthony Albanese and President Xi Jinping in Beijing.
Sean, I mentioned this one at the top of the show. Experts are warning that house prices across the nation could soon start falling, triggered by a drop in affordability and also by rising unemployment.
It seems like just a few weeks ago we were talking about how strong the market was, but it's really come off the boil. The housing boom and bust report by consultancy SQM Research, they're one of the best of the property gurus out there. So SQM says home values in Sydney, Melbourne, Canberra, Hobart and Darwin are all expected to drop next year, dragging prices nationwide down 1%. Sydney's forecast to lead the way down with a 4% drop. Of course, it's also been the fastest riser in 2023. SQM says with standard variable rates now in the high sixes and low sevens, would-be home buyers are being deterred, while some existing homeowners are experiencing stress. Understand that one. Also, migration growth has probably peaked. That'll take some of the steam out of the housing market, so the demand will come off slowly. And the unemployment rate, according to SQM, will rise towards 5% by the end of next year. That will certainly add to the downturn. Part of the reason why we're doing so well at the moment is people have jobs. SQM doesn't think there's a crash on the way, just a correction.
Sean, about a third of Qantas, Jetstar and Virgin Australia domestic flights were late in October, according to new official statistics.
And this is kind of good news because it's better than it's been, but still, a third.
That fits into that category that we talked about of very kind of qualified good news.
Yeah.
It's not really good news.
So some 73% of Qantas Group, and that includes the Qantas Link, arrived on time compared to 69% of Virgin Australia's network, including its regional airline. That's according to figures released by the Bureau of Infrastructure, Transport, Research, Economics. Virgin achieved the highest level of on-time arrivals among the major domestic airlines. That was at 68.6%. Jetstar was next at 68%. Qantas at 66.6%. The overall cancellation rate was 3.8%. Now, it sounds okay, but it's nearly double the long-term average. So pre-COVID, the overall cancellation rate averaged at about 2.2%. It's still at 3.8%. Before the pandemic, airlines averaged about 81% on-time performance. We're talking a lot lower than that now. Cancellations last month were again concentrated on Sydney Airport, but because it's the nation's biggest, it is the centre of the network. So when something happens at Sydney, it cascades into other parts of the country.
AGL Energy held its annual general meeting yesterday, Sean, and while the board was spared a second strike on pay, which would have resulted in a spill on all board members, its major shareholder still isn't happy with the company's efforts to decarbonise.
Mike Cannon-Brookes' Grok Ventures abstained from voting on the remuneration report, which allowed it to get through, but urged the board to set higher decarbonisation hurdles for executives wanting to earn long-term incentives. Grok's CEO, Jeremy Kwong Law, said the remuneration report incentivises the company to stand still while the rest of the energy market does the work. He called it old AGL thinking, whereby the company sat on the sidelines rather than leading from the front.
How about this one? A plan for US billionaire Paul Tudor Jones to invest in Fortescue's clean energy projects has turned a little bit sour, really, with the Wall Street icon's private office accusing the Australian company of breaching contracts and behaving in a, quote, unethical, immoral and unscrupulous way.
Yeah, so ranked by Forbes as the world's 299th richest person with a fortune worth more than $12 billion, Mr. Tudor Jones has pursued Fortescue for $6.25 million of costs incurred while investigating a potential energy partnership, according to a report in the Financial Review. A lawsuit filed in Connecticut reveals that Tudor Jones's flagship private company, Kidd Shelleen, worked with Fortescue on a plan to jointly acquire North American fossil fuel assets last year with a view to converting them to clean hydrogen production. Now, that relationship soured in late 2022 when Fortescue lodged a solo bid for assets it had jointly investigated with Kidd Shelleen. Then, according to the lawsuit, Fortescue refused to pay the due diligence cost accrued by Kidd Shelleen and its advisors. The news came ahead of the Fortescue annual general meeting in Perth yesterday. At the meeting, the board was dealt a first strike on executive pay. Chair Andrew Forrest used the meeting to unveil the green light on $1.1 billion worth of investments in hydrogen and renewable energy.
Okay, last one before we get to international news. Younger and lower income people feel increasingly pessimistic about their standard of living, but people over the age of 55 years are reasonably happy with what's going on.
This is the story of you and me, Michael. You're a miserable bunch.
I was just thinking that, and I'm like, no, don't point that out.
Oh, well, some of us are proud of being in their mid-50s. Others probably a bit ashamed of being in their mid-30s.
Why am I ashamed of my... Just move on, Sean. I'm
just going on the attack because I think I'm the one that's got the problem here.
Highly personal.
Basically, there's an intergenerational divide emerging, according to the Australian Unity and Deakin University Wellbeing Index. Broadly, satisfaction with the economic situation in Australia is at its lowest level in 22 years, even below global financial crisis levels. That's probably because of cost of living pressures, inflation, interest rates, housing affordability, etc. But people over the age of 55, the good guys, well, in terms of well-being, they're above average. Those under 55 years of age, the bad guys, are below average. Self-reported well-being was notably lower for people in households with gross incomes of $100,000 or less. I suppose that's not a surprise because what we're talking about, housing costs, for example, would really hit that group most of all. They certainly were finding things tougher.
I'm going to rise above your blatant attempts to bait me into an argument with you, Sean. We'll save it for the weekend edition. Now, in international news, very serious story. Another hospital in the Gaza Strip has come under fire as the World Health Organization warned that the enclave's devastated health system has largely collapsed, with none of its functioning hospitals capable of handling complicated medical cases.
At least 12 people were killed and dozens of others wounded in the latest attack on the Indonesian hospital in a northern city, according to the New York Times. It comes less than a week after Israeli forces raided Gaza's largest hospital, Al-Shifa, in an effort to capture and expose what it says are extensive Hamas operations within and beneath the hospital, including underground bunkers, a command center, and a network of tunnels. Hamas and hospital administrators deny that the militant group uses the grounds of Al-Shifa or other hospitals for military operations.
OpenAI's former boss, Sam Altman, who was sacked by the board of the artificial intelligence company, is going to join Microsoft, the largest shareholder in OpenAI. Sean, every day there is a new development in this story.
And it gets better. So it's going to make for some testy shareholder meetings. Could you imagine that Sam Altman, representing Microsoft, the major shareholder, turns up to meet the board?
Oh, the drama, the theatre.
That'd be fun. So investors were delighted with the news. That sent Microsoft's share price to a record high. Altman and former OpenAI president, co-founder Greg Brockman have been hired by Microsoft to run a new artificial intelligence unit at the company. About 2 or 3 hours later, the story got even better. It turns out that Microsoft, after hiring Altman, said it would be quite amenable to Altman and Brockman returning to OpenAI as long as the current board resigns. Apparently, a bunch of staff also signed a letter saying, bring them back, get rid of the board. Now, of course, OpenAI has already appointed a new CEO, former Twitch chief Emmett Shear. I suppose the bottom line for Microsoft is they want Altman working on AI for them, be that inside the company or at OpenAI. Who knows what happens next here? I reckon there's just a lot of fear and a lot of greed in this story, Michael.
If you were Emmett Shear, the new OpenAI boss, would you set up your desk?
Surely an AI world would be remote anyway, wouldn't you?
Yeah, that is a good point, actually. Well pointed out, Sean. Nicely done. Up next is the Fear and Greed Daily interview. Sam Weaver, General Manager of cyber insurance company Coalition.
All about cyber insurance, something that we should all be thinking about, whether you be in a large business or a small business, particularly given the hacking incidences that we've experienced recently.
Sean, it's coming up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au, all the usual places where you'll find that. Wednesday today, obviously, the new episode.
It's exciting.
Well, it suddenly dawned on me. You could hear a second epiphany. That's 2 epiphanies in one show. Here is the good news that we've been looking for today. How Do They Afford That comes out today.
Yes, you're right.
You know what the subject is.
Well, hold on. This will determine whether it's good or bad news. Yes. What's the subject?
It is what to do if you receive an unexpected windfall. So it's a very kind of optimistic, it's an aspirational kind of topic.
Anyone listening to this, rush off. Listen to How Do They Afford That for some good news.
Absolutely. It's all about there's the slightly unrealistic scenarios of, say, a lottery win or something like that. But then the more realistic ones of, say, a Christmas bonus or if you, say, sell a car or something like that, or even kind of then an inheritance. And there's some things that you need to be doing to make sure that the money just doesn't disappear very quickly, some kind of tax considerations, but also just some tips and tricks and hacks, as Canna likes to say, that might help you kind of set yourself up better using what might be an unexpected windfall. So I'll put a link in today's show notes so that you can find that one. I'm a little bit biased, but I think it is an episode well worth listening to.
I'm sure it is. I look forward to it.
Thank you very much, Sean.
Thank you, Michael.
It is Wednesday, the 22nd of November, 2023. Make sure you're following the podcast and please join us online on LinkedIn, Instagram, X and Facebook. I'm Michael Thompson and that was Fear and Greed Business News. Have a great day.